So what is an offset account really for? Offset accounts are designed to protect the future tax deductibility of an investment loan or a home loan that could be an investment loan in the future. Now, any broker, banker, spruiker, financial planner, property strategist, etc. telling you that it's somewhere to have all your income paid and use a credit card for your expenses to try and pay off your loan more quickly is wrong. They may be offering dangerous advice and should be avoided. If anyone tells you that redraw and offsets are the same, run. Now, to explain offsets properly, we need to consider the alternative, which is a simple loan with the redraw facility. Now, in this example, I'll assume that the loans are interest only just to keep the maths simple. So let's say Jack takes a simple $600,000 interest only loan, and instead of just paying the interest every month, he pays as much as he can afford off the loan. Now, simple loans typically have low rates and no fees, and after a few years, he manages to get his balance down to $500,000. So the bank will charge him interest on $500,000, but he has $100,000 available to redraw. Now, in Australia, redrawing funds from a loan is considered a new loan for tax purposes. So if Jack wants to redraw his $100,000 to upgrade to another home and turn his first place into an investment property, the bank will charge him interest on the full $600,000. But the ATO will say that $100,000 redraws for personal purposes and is therefore non-deductible. Only the interest on $500,000 is deductible to his original home, which is now an investment property. And due to this quirk of Australian tax law, banks invented the offset account to allow us to keep our savings separate from our loans, but still get the benefit of lower interest costs. Now, unlike Jack, Amy gets a loan for $600,000, but with an offset account. Now, her income and expenses are identical to Jack's, but she puts all her surplus funds, all her savings into the offset account and lets that just pay the interest on the loan. Now, if interest rates are the same as Jack's, she will reach $100,000 in her offset at the same time as Jack has paid down his loan to $500,000. The bank charges her interest on the difference between the $600K loan and the $100K offset, and that's $500,000. So while she's got her money sitting there, the two are working the same as it is for Jack. The difference comes when she wants to move into a new home and convert her current one into an investment property. She can use the $100,000 as the deposit for the new home and not change the deductibility of the $600,000 loan. The interest on that full $600,000 will be claimable against the rent for her, giving her roughly $5,000 a year extra as a tax deduction versus Jack. Now, this would also be the case if they both started with an investment property and wanted to buy a home. But the reverse is true if they're in a long-term home and draw the funds to buy an investment property. Now, Jack would be able to get a deduction on the $100,000 he redrew because he redrew it for investment purposes, whereas Amy cannot claim a deduction for the $100,000 taken from her offset account because it's considered a personal savings account. Now, offset accounts do come with a big risk, which is that people are less likely to redraw from a loan to buy stuff, and they're more likely to spend from the easy access offset account. To protect herself from this risk, Amy sensibly decides to never have a debit or credit card linked to her offset account and continue her everyday banking with a different bank to where she's got her loans. Now, if you want to know more about the offset myth or the alternative use of an offset, then I'll make another video just on that. My name is Max Phelps, and remember to always be genuine, have fun, and stay curious.